Picture an ordinary Monday that begins exactly like every other one. The sun comes up. Motorbikes and cars thread through traffic. Your phone vibrates with notifications. The world feels stable, predictable, almost automatic. And then you do the smallest, most modern act of trust. You open your banking app. It doesn't load. You try again. Nothing. You restart your phone. You switch networks. Still nothing. You walk to the nearest ATM, the one you've used 100 times without thinking, and it greets you with a message that feels harmless at first. Out of service. You step into a convenience store, pick up what you need, tap your card declined. The clerk flips the terminal toward you like it's your fault. Another attempt. Another decline. A little laugh. A little irritation. For the first hour, it looks like a glitch. For the second hour, it starts to feel like a pattern. And by the time you reach for the news, the sentence you read is so calm, so sanitized, that it almost sounds polite. Major banks temporarily suspend operations. Temporarily. That word is the sedative. The word that buys time. The word that keeps a city moving for just a little longer while the foundation quietly cracks beneath it. Because when people imagine a financial collapse, they imagine the dramatic version: sirens, riots, smashed storefronts, panic in the streets. But the true beginning of a banking shutdown is something far more unsettling. Normal life continuing on top of a failure it doesn't yet understand. People keep trying to swipe cards. They keep refreshing apps. They keep assuming the system will snap back into place, because it always has. And that assumption is the real engine of modern civilization. Not money. Trust. Money is the language we use to label value. But trust is the invisible bloodstream that keeps the language alive. Trust is what makes a grocery store believe your plastic card represents real purchasing power. Trust is what makes your employer believe a payroll file equals wages. Trust is what makes a landlord believe a digital transfer equals rent. Trust is what makes a hospital believe an insurance authorization equals payment. If that trust stops flowing, even for a day, the world doesn't explode immediately. It melts. Quietly. Incrementally. Like ice turning to water. And here's the part most people don't realize until it's too late. The money you think you have doesn't exist in the bank the way you imagine it does. It is not sitting in a vault with your name on it. It is a promise. A claim. A line in a database backed by a system built on confidence. Confidence that works perfectly right up until everyone tries to redeem it at once. So if banks shut down tomorrow, it wouldn't just be a story about panic. It would be a story about something more terrifying. How thin the line is between normal life and a civilization discovering it was built on belief. And even past it, and with self. And once you see that line, once you feel it, you can't unsee it. After the first day, confusion begins to harden into fear. Not because people suddenly understand the system, but because the system stops responding to belief. Screens stay dark, transactions don't clear, salaries don't arrive, and slowly, an uncomfortable question moves from the edges of thought into the center of attention. Where is my money? Most people grow up believing a simple story. You work, you earn, you deposit. The bank keeps your money safe until you need it. That story feels intuitive, almost physical, as if somewhere behind the glass and steel there's a pile of cash quietly waiting for you. But that's not how modern banking works. When you deposit $1, the bank does not store it. It transforms it. That dollar becomes a loan, or a fraction of many loans. It is multiplied, leveraged, reinvested, and promised to multiple parties at the same time. On paper, it looks efficient, elegant, even brilliant. $1 supports many claims, many transactions, many layers of economic activity. This is fractional reserve banking, and it functions on a single, fragile assumption. Not everyone will ask for their money back at once. As long as withdrawals are staggered, confidence remains intact. Accounts balance. Payments clear. The illusion holds. But the moment that assumption breaks even briefly, the structure reveals its true nature. 100 people believe they own the same dollar because the system told them so. And belief, not cash, is what keeps the math from collapsing. This is why bank runs are so deadly. Not because banks are malicious, but because they are designed to fail under collective fear. The system is stable only when trust is unevenly distributed over time, synchronized doubt, and the mechanism jams. In a digital world, this vulnerability is amplified. Less than a small fraction of money exists as physical cash. The overwhelming majority lives as data entries on servers, reconciled across institutions, jurisdictions, and networks that assume constant connectivity. When banks shut down, that digital money doesn't wait. It vanishes from circulation. Commerce stalls first, not with violence, but with friction. Payroll systems freeze. Businesses can't pay suppliers. Rent doesn't move. Ride-sharing apps fail. Grocery stores reject cards. Not because food disappears, but because settlement does. And here's the cruel paradox. The more advanced a financial system becomes, the more dependent it is on uninterrupted trust. The efficiency that makes daily life seamless also removes redundancy. There is no paper fallback, no gold window, no manual override. Just numbers on screens, waiting for permission to move. History has seen banking collapses before, but never like this. Never at a scale where nearly every transaction, every obligation, every proof of ownership exists only as synchronized belief across machines. In the past, when banks failed, commerce slowed. Today, if banks fail, commerce stops. Not loudly, not immediately, but completely. Because once people realize their wealth was never a thing, only a promise, the fear isn't about losing money anymore. It's about losing the map that tells them how the world works. And when that map dissolves, panic doesn't scream, it spreads. Once trust breaks at the banking layer, the damage doesn't spread evenly. It cascades. And it always starts in the places people least expect. Within hours, ATMs run dry. Not because cash is gone, but because replenishment systems can't settle accounts. Trucks don't roll without payment confirmation. Fuel distributors don't release supply without cleared funds. The machines don't argue, they just stop. Stores are next. Large retailers, optimized for speed and digital efficiency, turn customers away. Card terminals fail. QR codes mean nothing. Even businesses that want to help can't, because their own suppliers are frozen upstream. Inventory exists, but circulation doesn't. Shelves don't empty because of looting. They empty because logistics stall. Gas stations follow. Fuel is one of the most payment-sensitive commodities on Earth. Margins are thin. Deliveries are constant. The moment settlement fails, pumps shut down. And when fuel stops, everything else slows. Commuting collapses. Deliveries halt. Emergency services begin rationing. What makes this moment different from past crises is timing. Modern economies run on just-in-time systems. Food arrives hours before it's sold. Medicine is stocked based on forecasts, not reserves. Power grids depend on constant financial coordination between producers, distributors, and regulators. None of these systems were designed to survive a pause in money. And yet, at this stage, panic still isn't loud. People wait. They assume restoration is coming. Governments appear on television, urging calm. Officials repeat the same phrases: history always provides, deposits are safe, systems are being restored, this is temporary. But behind those reassurances is a race against something far more dangerous than insolvency: time. Because the longer payments stay frozen, the more society shifts from inconvenience to improvisation. Employers start issuing IOUs. Landlords negotiate delays. Hospitals quietly prioritize emergencies over routine care. Schools close, not because of disorder, but because staff can't be paid. And slowly, something profound happens. Money stops being the organizing principle of daily life. Relationships take its place. Who trusts whom? Who owes whom? Who can provide something tangible in exchange for something else tangible? Barter emerges not as ideology, but necessity. Cash, once dismissed as obsolete, becomes powerful again, not because it's modern, but because it works without permission. This is the moment where fear turns physical. Lines form. Not riots, but queues. Grocery stores. Fuel depots. Pharmacies. People aren't panicking yet, they're recalculating. And beneath every interaction is the same unspoken realization. If the system doesn't come back soon, the rules we live by will have to change. Not tomorrow. Not in theory. Now. Because a society can survive inequality. It can survive inflation. It can even survive debt. But it cannot function when payment, the invisible glue between strangers, disappears. And once that glue dissolves, the question is no longer whether the system failed. It's who gets to rebuild it. By the time governments admit the shutdown isn't a technical issue, fear has already reshaped behavior, not through chaos, but through memory. Because financial collapse is not a new experience for humanity. It lives in the collective subconscious, passed down through stories, warnings, and inherited trauma. Every monetary crisis follows the same emotional sequence. First comes disbelief. People insist this can't be happening, not here, not now, not in a modern economy. Then comes anger. Banks are blamed, politicians are blamed, foreign actors, hackers, enemies are blamed. Finally comes desperation, when people realize outrage doesn't restore access to their own money. We've seen this pattern before. In 1933, during the Great Depression, Americans lined up outside banks to withdraw savings that no longer existed. Franklin Roosevelt closed the entire banking system in what history politely calls a bank holiday. For days, people had no access to accounts. The difference then was physicality. Cash existed in homes. Commerce slowed, but it did not vanish. In 2008, the collapse of Lehman Brothers nearly unraveled the global financial system. Central banks injected trillions to prevent total failure. They called it liquidity. What it really was manufactured confidence, new money created to stop fear from spreading faster than institutions could react. Those were tremors. Today's system is an earthquake waiting to happen. There is no gold anchor, no physical fallback, no separation between money and machine. Every dollar, euro, or yen is a belief synchronized across servers. When that belief fractures, fear spreads at the speed of information. Look at Lebanon. In 2019, citizens woke up to discover their bank accounts were frozen. Withdrawals were capped. Savings evaporated on screens. The currency collapsed by over 90%. Doctors, engineers, teachers, people who had done everything right, found themselves begging for access to their own wages. Lebanon had once been called the Switzerland of the Middle East. Trust built it. The loss of trust destroyed it. What makes a global shutdown catastrophic isn't just financial loss. It's psychological disintegration. Money in the modern world isn't metal or paper. It's a shared myth. A story we all agree to believe, because believing makes daily life possible. When that story breaks, people don't just lose savings. They lose orientation. Governments respond with authority. Emergency decrees. Bank holidays. Restrictions on movement. Central banks flood the system with newly created money to restart circulation. But this cure carries its own poison. Inflation. Printing confidence doesn't restore faith. It postpones reckoning. Because you cannot create trust by creating digits. Yet history shows that is exactly what authorities try to do. And when it works, even temporarily, it leaves a scar. A population that has learned the system can be rewritten overnight. A society that understands ownership is conditional. That understanding doesn't disappear when the crisis ends. It lingers. And it changes how people relate to power. Because once fear enters the financial system, money stops being a neutral tool. It becomes a weapon used to calm, to coerce, and to control. And that is when collapse stops being economic and becomes political. When panic reaches the level where order itself feels threatened, power moves quickly, not to ask permission, but to restore predictability. Because in moments of systemic fear, people don't demand freedom, they demand safety. And that demand reshapes the future. After a global banking shutdown, governments would not wait for commercial banks to recover trust on their own. The risk would be too great. Bank runs would be permanent. Confidence, once shattered, doesn't return easily. So the solution would arrive wrapped in the language of modernization and protection. Central banks would step forward. They would guarantee digital balances, suspend loans, freeze debts, inject liquidity directly into accounts, not through banks, but around them. What would be presented as emergency stabilization would, in reality, mark a structural shift in who controls money. This is where central bank digital currencies enter the story. They would be introduced as the answer to fragility. One account per citizen. Direct settlement. No intermediaries. No bank runs. No delays. Governments would promise that money would always be accessible because it would live inside state-controlled infrastructure. On the surface, it sounds like resilience. Underneath, it is consolidation. Programmable money allows rules to be embedded directly into currency, where it can be spent, when it can be spent, whether it can be saved. Transactions become permissions. Accounts become policy tools. Financial privacy becomes a legacy concept, discussed the way we now discuss cash nostalgically. History tells us this pattern is not accidental. After the financial crisis of 2008, banks didn't become smaller. They became larger, more centralized, more intertwined with the state. After the pandemic, governments gained unprecedented authority over movement, labor, and spending. Every crisis expands the surface area of control. A banking shutdown would be no different. It would be framed as a failure of decentralization and a justification for unification. Stability would be traded for autonomy. Convenience would replace consent. And here is the dangerous paradox: many people would welcome it. After chaos, any system that promises order feels like progress. Fear narrows imagination. It makes alternatives seem reckless. But control introduced during emergencies rarely retreats when emergencies end. A world rebuilt after a banking shutdown would not look like the old one repaired. It would look like a new architecture, more efficient, more legible to power, less forgiving to individuals who fall outside its rules. The end of banks would not mean the end of financial empires. It would mean the birth of a different one. Invisible, algorithmic, absolute. And yet, history never moves in a single direction. Because whenever institutions overreach, something else emerges in the cracks they leave behind. Something older than systems. Something human. When centralized systems seize up, life does not stop. It reroutes. History is unambiguous on this point. When formal institutions fail, informal systems rise to take their place, not out of ideology, but necessity. People do not wait for permission to survive. They improvise. As banking rails remain frozen, value begins to detach from screens and return to physical reality. Gold resurfaces because it exists without servers. Cash regains power because it settles instantly. Barter reappears because it requires no intermediary. Farmers exchange food for fuel. Mechanics trade repairs for supplies. Local stores extend credit based not on algorithms, but on memory and reputation. The abstract language of finance gives way to tangible exchange, and money stops being an idea managed by institutions and becomes a tool negotiated between humans again. This is not romantic, and it is not equal, but it is revealing. Collapse does not destroy societies. It destroys layers of abstraction. Rome lost its imperial currency, yet trade continued locally. Argentina's peso collapsed, yet street economies flourished. Lebanon's banks froze accounts, yet communities rebuilt parallel systems of trust. The same pattern would repeat globally. Skills would matter more than credentials. Relationships would matter more than balance sheets. Ownership would be defined less by digital records and more by possession and social recognition. In stripping away efficiency, collapse exposes something modern finance obscures. Civilization is not sustained by institutions alone. It is sustained by cooperation. And once people experience that reality directly, once they understand that systems are replaceable but human trust is not, the world that emerges after the crisis cannot simply revert to what came before. The most dangerous moment does not arrive when banks shut down. It arrives after. When the fear settles. When improvised systems begin to function. When people realize the world did not end. It simply changed shape. That is when the fight over the future truly begins. Because every collapse creates an opening. Whoever restores order after chaos gains legitimacy, and whoever gains legitimacy gains power. History is consistent on this. Financial collapse in the 1930s reshaped politics across Europe. Hyperinflation rewired entire societies. Banking crises do not just destroy wealth. They rearrange authority. They decide who writes the rules next. If banks shut down tomorrow, governments would race to rebuild trust faster than people can adapt on their own. A unified digital system would be presented as protection. One account per citizen. Direct settlement. No intermediaries. No bank runs. Safety, efficiency, permanence. But permanence is always the promise made right before control hardens. What begins as stabilization becomes normalization. What begins as emergency becomes architecture. And once money is fully programmable, fully traceable, fully conditional, freedom quietly trades places with convenience. Yet collapse also carries another possibility. Revelation. When people witness the illusion break, they begin to question assumptions that once felt unshakable. They see that money is not wealth, but belief. That ownership is not guaranteed, but granted. That systems endure not because they are eternal, but because people keep agreeing to them. Rome believed itself permanent. Britain did. America does. History is indifferent to confidence. So, what happens if banks shut down tomorrow? The world panics. Systems freeze. Power shifts. But then something older reasserts itself. People adapt. Trust reforms in smaller circles. Value reconnects to reality. The system may fall, but the story does not end. It resets. Smaller, harder, more human. And that is the paradox of collapse. It destroys one illusion only to expose a deeper truth. Civilizations are not built on money. They are built on trust. And once you understand that, you realize the most fragile thing in the modern world is not the economy. It is the belief that it cannot change.